All right, we're on chapter 1 of Intermediate Accounting 1, and we are talking about the environment, theoretical structure of financial accounting. At this point, you should have already had Principles of Accounting 1 and 2. So these first few chapters should be kind of a review. We might go a little deeper in a few things than we did in Principles. Also, remember, chapter 1 of most college textbooks is a huge overview of the whole book, okay? So don't stress if you think it's like too much. Remember, it's probably just giving us a big overview of the entire book, which is 23 chapters. We will do chapters 1 through 12 in Intermediate 1, and then 13 through 23 in Intermediate Accounting 2. All right, so let's get started. And we're going to kind of talk about why is accounting important? Okay, it's important because it produces information that we'll use to make good decisions. Okay. Also fosters a prosperous society. Okay. So one of the things I probably asked you in principles is like, if you think about all the transactions that Walmart makes, if all those transactions are just in a room, just floating around in a room all by themselves, that is not information we can use. In accounting, we're going to take that information, we're going to run it through that accounting process, and then we're going to end with financial statements that we can make decisions on. So if you just kind of think about that, they got this nice little diagram here. If you just think about all those transactions of Walmart just floating around in a room, it's chaos. Okay. We run it through this accounting system and we end up with financial statements that help us make good decisions. Okay. What is the primary focus of financial accounting? Primary focus of financial accounting is external users, people outside of the organization. Remember, we have to follow those rules of GAAP, generally accepted accounting principles. Okay. It provides information to investors, creditors, and other people outside of the organization. Okay. So financial accounting, we have financial statements, and this is a little frustrating to me because these statements are not in order. Okay. I've been preaching that since day one of Principles of Accounting 1, that these financial statements have to be done in order. They cannot be done out of order. The first one is always going to be your income statement. Okay. We are talking mostly about corporations in intermediate. So remember, we don't have the owner's equity, we have the stockholder's equity. The second is the statement of, I'm just going to abbreviate SE, stockholder's equity. So one, two, then the third one is the balance sheet. And the fourth one is the statement of cash flows. We covered statement of cash flows in Principles 2. We will look at it again because statement of cash flows tends to be an area that a lot of students struggle with. Okay. Remember, those have to be done in order because to do this statement of stockholders' equity, I need the income. I need the net income from the income statement. I can't do the balance sheet because I need that number off of the statement of stockholders' equity. Okay. So even if the problems tell you to do them in this order, don't listen. Do them in this order, okay? Because you'll just be working yourself in circles over and over again, okay? So, financial information providers and external user groups. So, most everything we're going to be talking about here is profit-oriented companies because that is what a corporation is. A corporation is focused on profits. I do realize that there's a lot of people who just think all corporations are bad. They're really not all bad. Are there bad corporations? Yes, there is. But just because there's a few bad ones doesn't mean they're all bad. Okay. Corporations is just how they organize the business. And I've always used, we think about this big pie is the corporation. And then these little slivers are pieces of the pie, it we have those shareholders or stockholders. Okay. So happy little stockholders. Okay. The beauty of a corporation is that I could own one share of Walmart stock. If Walmart goes bankrupt, they can't cross this bubble and get my personal assets. Okay. So remember that. And there's a reason why they can't do that. That corporation's a complete separate legal entity in and of itself. Okay. Remember, the reason that it can't cross that bubble is because this entity, this corporation, is taxed first at the corporate level. Corporations have to do a tax return. Okay. There is corporate tax returns. And then for me to get my money out of the corporation, I'm going to get this thing called dividends. Okay. And then once I get those dividends, it is taxed for the second time. Okay. So when you hear people talking about corporations not paying their fair share of taxes, you understand they do. Okay. People who say that really, um, they're either acting dumb or they're playing dumb. I don't know. But corporations pay a lot of taxes because they're double taxed. And who are these people that own these corporations? They're me and you. Okay. They're not all Bill Gates and Elon Musk. Okay. I have a retirement plan. In my retirement plan, I own shares of stock in many corporations. Okay. So it's me and you. Our dollars are getting taxed again. Okay. So don't think of big corporation as being big and bad because you probably, depending on where you're at in your career, you probably have a retirement plan. And if you do, that's what you're invested in. It's either stocks or bonds, one of the two from these corporations. Okay. All right. So profit oriented, we can have not for profit. Realize we have a whole section, another whole accounting class on not for profit charitable organizations. Then, and that these are the government regulatory agencies. And then we have households. They'll sort of fall into that financial intermediaries, financial analysts, stockbrokers, mutual fund managers, credit rating organizations. Okay. We're primary right here in that area. Okay. All right. So we're going to talk about capital markets. We actually talk about this in financial management as well. And this is new. This is a new book that I'm using. And I don't think I ever remember them talking about the capital markets in the intermediate accounting. We talk about it in financial management, but there are capital markets. Okay. This provides a mechanism to help the economy allocate resources efficiently. Okay. And how that works is we don't necessarily, if we want to invest our money, we don't have to like physically go and find somebody who's got a good business idea and, hey, we're going to put our money in your business. Okay. We don't have to do that. We have these capital markets. We can go put our money in a mutual fund and they can decide who to loan money to. Okay. Or what stocks to buy in different companies. So it's very efficient. It's a lot more efficient now than it used to be like during the Great Depression. And that was one of the reasons, the stock market crashed way back then because they didn't have a government entity overseeing some of these things, which now we do. And I'm not saying that we'll never have another Great Depression. We could, you just never know. But there is a lot of things in place now, like controlling the interest rate, that really helps us not to go there. Okay. And I kind of talked about corporations already. There are other organizations like an LLC, partnership, sole proprietorships. Mainly, if you're going to be a corporation, it's when you want to pull a lot of money in for investing. So I'm going to write the accounting equation out because I love to write the accounting equation out. Okay. So we have bonds underneath liabilities, that's debt. And then we have stock underneath here. Okay. Those are the two ways that we can pull a lot of money into a corporation. Okay. If it's just me trying to build a corporation, I can only borrow so much money. I can only issue so many stocks. But if we make this big corporation, then we can pull a lot of resources together. Okay. Helps the businesses. It helps those businesses acquire the capital. They get money from here and here, and they buy big assets that are going to make them more money. Okay. All right. We have the investment credit decision. This is a cash flow perspective. Why do investors and creditors provide capital? Because they want to earn a fair return on their resources. We want to earn a fair return. Y'all may not be working now. You will be working soon. You're going to have a retirement plan. And in that retirement plan, you are going to want to make a good return on that. Okay. Because you're investing your money and you want it to grow and grow and grow and grow so that you can be rich when you retire. Okay. Shareholders will receive cash from one, the sale of the ownership of the shares of stock and periodic dividends. I talked about the dividends. Okay. That's how they get their money out of the business. But we have happy little stockholder here, happy little stockholder here, and we have another one coming in. Let's just say, okay, this stockholder owns shares of stock and they're going to sell their shares of stock to somebody else. They might make a gain on that. Okay. They may have a gain, they may have a loss, which we don't want to think about that, but it could be a loss. Okay. So there's two ways that the shareholders get their money out of the corporation. Okay. Dividends comes from internally, then the sale of the stock increasing, which the stock value increasing is investors and people on stock market looking at the financial statements and saying, hey, doing some of those key ratio analysis, it looks like this business is going to grow. Okay. They're basing that stock price on what they think things are going to do. Okay. They don't really know. Okay. There is an uncertainty or risk when it comes to this because you don't know which businesses are going to succeed and which ones are going to fail. There is a lot of key analysis that we can look at that will give us really good information and insight as to whether this company is going to succeed or not. Okay. Remember, if we have a high risk, we have a high return usually. Okay. So if we invest in a company and it's like 20% interest, there is a high risk of that not coming to fruition and us losing our money. Okay. I always kind of compare like home mortgage loans, a house that is on a concrete foundation, affixed a um, to the ground is going to have a lot less risk because the default rate on home loans like that is very little. Okay. My husband and I had to live in a trailer for the first 7 years of our marriage, which is nothing wrong with that. But the interest rate on that was way higher than any of our other home loans were. Okay, because there is a high risk of default when it comes to mobile homes and things like that. And there's nothing wrong with it. I'm not saying that, but there is a high default risk. So a lot of times that interest rate is a lot higher than a traditional home with a concrete foundation affixed to the ground. Okay. All right. So to calculate rate of return, they give us a really good example here. This says that assume the investor provides a company with $10,000 cash by purchasing the stock at the end of 2026. They get $400 in dividends from the company during 2027, and then they're going to sell the ownership of those stock for 10,600. So here's the $400 they got in dividends. Here's the appreciation of the stock, 600. Add those together, divide it by the initial investment, and that was a 10% rate of return. Okay. And, me and you can't think of, we probably can't even think about paying 10% on anything, but you could have some of these investments could have a rate of return of 10% or even higher. Okay. All right. So they give us an example here and they went ahead and gave you the answer, but I guess they've already got it wrote out here, but this is Creature purchased $200,000 worth of stock, received 4 quarterly dividend payments of $1,000 each. So over a year, they received 4,000. They sold the Troman stocks for 206,000 after 1 year. So then we had 6,000 in appreciation. That's 6,000 over what we initially purchased it for. Those two divided by the 200,000 gives us the answer that is already circled, 5%. Okay. And you can see how they calculated that down there. That's still not a bad rate of return. I mean, most savings accounts might not be paying quite that much. Interest rates are a little bit higher right now as of this recording, because it kind of went up because our economy like just went crazy after COVID because there was so much money thrown into the economy by stimulus, which is fine. Not against that either. I got some stimulus money and lots of money thrown into the system. Interest rates were super low, and I mean, anybody that didn't see the 8% inflation we experienced was, I mean, we knew inflation was going to come because that is a recipe for inflation. So the interest rates have gone up over the last few years and it's starting to come down. I'm starting to see groceries come down just a little bit. Okay. More of that you will learn in your economics classes. Okay. All right, example of uncertainty. So we're going to consider the following two investment options. Which would you pick? They said investing $10,000 in a savings account insured by the US government, and it will generate 5% rate of return. Okay, so we have that risk return trade-off. Most investors would invest in profit-oriented company only if the potential return is high enough. They're going to want it to be over 5%. They're not going to invest in any of those profit-oriented companies for anything less than 5% because they can literally put their money in the savings account, don't have to worry. It's backed up by the government. Even if the bank goes bankrupt, they're going to get their money. Okay. So they're pretty much like that's the basic, that is the minimum that they can earn. So they're probably not going to put their money in any risky company for less than the 5%. Okay. So let's kind of talk about the objective of financial accounting. So provided information should be useful for decision making. When we get to those financial statements, remember that's the last step in the accounting process. We should be able to make decisions from that. Okay. Information should help investors and creditors evaluate the following characteristics of an enterprise's future cash receipts and disbursements. So amounts, timing, and uncertainty. So amounts, are they going to pay us are they going to pay us a dividend every year? Or are they going to pay us no dividends? Okay. When are they going to pay those dividend on timing? And then uncertainty. Okay. All right. So we have, since Principles 1, been talking about the difference between cash versus accrual accounting. Okay. Cash basis accounting is pretty much cash coming in, cash going out. Okay. We don't make a lot of accrual entries because we don't really care. Okay. But I've been beating accrual-based accounting in your head ever since Principles 1 because cash basis does not give us really good information. Cash is important because cash still pays the bills, but it's not the only important thing. Okay. It is our job to measure revenues and expenses in an accrual basis. Remember, we might have salaries that we owe at the end of a year, and we had to make that adjusting entry to accrue the salaries that we've had, even though the cash isn't going to go out until the following year. Okay. So that's the difference between those two. Again, we're still going to do a lot more accrual-based accounting. We'll do the statement of cash flows, and that will help us make informed decisions on our cash flows. Okay. Where's our cash coming from? Where is our cash going? All right, so they give us an example here. This is Malik Company. They paid $60,000 for 3 years rent at the beginning of year one. Okay, I don't know if they put that here, but what's our journal entry going to be? We would debit, just a little review, prepaid rent is an asset. We would debit that for $60,000, credit cash for 60K. Okay. So we're going to look here at 3 years. Okay. So year 1, 2, and 3, they all had $100,000 in sales. Okay. Cash of 60,000 went out in year 1, but that really covered 3 years. Okay. It covered 3 years of rent. 60,000 divided by 3 should be 20,000 K every single year. Okay. So under cash basis, you can see cash went out here, nothing in year 2 and 3. So, some people would look at that and be like, oh, wow, that's a negative cash. Let's just shut everything down. Don't do that. No, don't do that. Because look, it's coming back up. You just had this big cash outlay in year one. And that happens to a lot of businesses, especially when they first start. They're borrowing a lot of cash. They're pulling a lot of cash in from financing and investing. I'm sorry, financing, and then they're putting it in investing, but they're not bringing in a lot of cash for operations. Okay, so this is what it looks like under the cash basis. Now let's look at the accrual basis. Okay, so under the accrual basis, yes, the cash went out, but only $20,000 hit the income statement every single year. Okay, it kind of looks like we smoothed earnings out there. We really did not, because anytime you use that terminology, that's a risk because that's not what we do as accountants. Okay. We took that $60,000. It was for 3 years. We just divided it out between the 3 years. Okay. All right. So I'm going to skip that because I don't want the videos to get too long here. Okay. So the next thing is importance of environmental, social, and governance, ESG. I've not ever seen an accounting textbook throw this in, but I do mention this quite a bit when it comes to audit, because you being the auditor and looking at a business, you can see everything. Okay, you see everything that's going on, and even if they are dumping toxic waste in the river, that doesn't sound like that affects accounting, but it does, because if they're going to get caught, they're going to have to pay a fine, and that affects the accounting records. There is almost nothing that doesn't affect the accounting records. Okay. There's social things. And now, and these days, we expect corporations to be good corporate citizens. We don't like investing in corporations that don't do anything but profit generated. We want to see a Tom's, like the shoe. We want to see, oh, yeah, for every pair of shoe you buy, Tom's will donate a pair of shoes to a kid without shoes. Tacos for life. Those are great business plans, but that's, 50 years ago, we didn't care how corporations behaved. Their job was to make money. Their job is still to make money, but it makes us feel good when we go to these places because they are helping something else. So we are expecting corporations to be good citizens, which I'm not saying I don't, but their primary reason is to make money. Okay, that's the only reason the corporate form was invented, was to make money. Okay, but we do care about these things because nowadays, if a company is like not environmentally friendly, even if they assume they're not environmentally friendly, they attack them, don't they? Okay. Corporations have to take a stand on different things, which shouldn't matter. Their job is to make money. Their job is to produce a product that everybody likes or loves, and that's what their primary job is. Okay, I'm going to end the video here, and we will pick up on the next. You can't really see the learning objectives, but we did learning objective 1 and 2 in this video. Next video, we will do learning objective 3.